What's an inverted yield curve? What does it mean for the economy? And tangibly, what does it look like, feel like? What's it mean to you? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so we were inverted. Top Gun, old school Top Gun reference. Inverted in the economy, though, is not a good thing, okay? Hilarious in that movie, famous quote by Goose and Maverick, but not a good thing in the economy. And so let me give you an example. So that what we're talking about here is the yield curve inverting, which is as like snooze fest as you can get, as geeky as you can get with the economy, but gets a lot of attention because of what this has signaled out there in the economy. So let's get real practical, because we're working with lots of folks that are looking at retirement, have either just transitioned into retirement over the past couple of years and saying, wait a second, this market volatility is wild. What could we do to help make my income more predictable? Or folks that are on the verge of retirement, and you might be looking at this as well, building out some CD ladders or bond ladders, trying to capture today's high interest rates before rates drop back again, as many people are anticipating, because inflation appears to be dropping again. So the yield curve goes from this sort of really geeky thing to, whoa, what's it mean for the economy, to real life, what's it mean to you? So when the economy is functioning normally, you have an upward sloping yield curve. Let me give you an example. This is real life, literal example, okay? So if I were to ask you to loan me $10,000 and I said, I'll pay it back tomorrow, you might size me up and say, well, do I like this financial risk? But then you would charge some sort of interest, right? Because we're not friends, we are friends, but you know, you would charge interest on this, but you'd say, what could happen in a day? So I'll charge you interest, but you know, a small amount. Okay, well, what if I said, I need that 10 grand, can I borrow it will you loan me that 10 grand? I'll pay you back in a month. And you might say, well, yeah, I mean, that's still pretty safe. A month, what could happen? I'll have a little bit higher interest rate than the overnight loan, but still not that high. Okay, what about I'll pay you back in a year? I'll pay you back in a year. You'd still say, well, I mean, stuff can happen in a year, so I'm going to raise the risk is a little bit higher, so I'm going to charge you a little bit more interest, but still, that's not bad. What about 5 years? What if I said I won't pay you back for 10 years? What if I said I'm not going to pay you back for 30 years? Suddenly, as that time goes on, you can say, oh my goodness, I think you're a good credit risk today. I'm willing to lend you the money today, but gosh, a lot could happen in 10 years or 30 years. You might be a good risk today, but maybe out there in the future, you make some bad financial decisions, your health changes, something changes, and you're not a good risk then, and I'm still waiting to get my money back. So I'm going to have to charge you more interest the longer that loan is. I mean, does that make sense? Most of us don't think that way about the yield curve and bonds and those sorts of things, but that's actually what happens. And therefore, in a normal functioning economy, there should be an upward sloping yield curve, meaning longer term loans should have a higher interest rate than shorter term loans. Makes sense, right? Well, when there are distortions, when the economy's not operating normally or not really operating the way it's supposed to, we get these abnormalities, these distortions where the yield curve is inverted. And that means short-term interest rates are higher than longer-term interest rates, which means I could ask you to lend me 10 grand over a year, and you could charge a higher interest rate than if I said, hey, can I borrow this money for 20 years or for 10 years? And that would be at a lower interest rate. Doesn't make sense. Doesn't make sense. So to me, you only get these inverted yield curves when there is manipulation, when there's been a heightened amount of manipulation out there in the economy. Guys, we wrote the book on it over the past 3 years. And where there's been other times as well where the Federal Reserve or there are forces at work out there pushing interest rates higher in the short term, where interest rates in the long term say, yeah, I don't buy it. We don't need to command such a high interest rate over the long term because this is just a short term abnormality with interest rates. they're not getting bid up that much over the long term. So there's a couple personal applications here when the yield curve gets inverted, but to continue to make it more tangible, take a look right here. Now, this is just a sample, but I've been showing some clients this, especially clients that are on the cusp of retirement or in retirement as we're building out CD ladders, bond ladders. I'm going to explain that in just a second. And so been showing what this looks like. So guys, this is real life. This is real life, just a sample from a couple weeks ago. So things change all the time, but take a look here that, let's just say a U.S. Treasury, a 1-year U.S. Treasury in this scenario is paying 4.83% interest rate. But an 18-month U.S. Treasury, so a loan that you're offering to the government, and then they're going to pay you interest and then pay that loan back to you 18 months later, that's only at 4.71. And you might say, listen, geek, stop it. It's not that big a deal. That's not a big difference. Well, it sort of is, okay? What about a 2-year? A 2-year 4.4% compared to a 1-year 4.8. That doesn't make any sense. 3-year 4.09. 4-year 3.92. 5-year 10 years. So get this. So if you wanted to loan your hard-earned money that you've saved up to the government and said, pay me back in a year, they're going to pay you, they're willing to pay you 4.83%. But if you say, nah, I don't need the money back in a year, I trust you, just pay me back over 10 years. That's going to give you a lower interest rate, significantly lower, about 1% lower per year for 10 years. That doesn't make any sense, guys. Again, this is a distortion. So tangible, seeing that clearly, what does this mean for you? Number one, for those of you that are looking, as we sort of are, and saying, well, even the Federal Reserve has been increasing interest rates, but they're starting to do so more slowly, and they're sort of even projecting that they're going to start lowering interest rates at some point in a year or so. Let me lock in these interest rates today. Because, hopefully the long-term stock market's going to be able to outperform 4 or 5%. Historically, it has. But for my bonds or for some money that I'm going to need in a couple years, let me just lock it in, and I kind of limit the volatility on it, and I'm able to get a good interest rate before things drop back down. Well, and this is demonstrating that, well, you can get a good interest rate if you're going to, tie the money up for a year. But if you look and say, well, I don't need this money for 5 years. I don't need this money for 6 years. Let me lock in these good interest rates. The interest rates aren't that good. They're actually worse the longer you try to lock it in than compared to a short-term interest rate. Does that make sense? So for a lot of folks, we've talked about this before, as you're entering retirement or on the cusp of retirement, you need to take a fresh look at your overall investment strategy, especially in light of all the wind patterns and how things are more challenging, unique today with volatility and whatnot. You need to look and say, how much money from my investments will I be drawing out within the next 2 to 3 years? That money should be very, very short-term, very liquid, and low risk. And then how much money am I going to need from year 3 to year 7 or year 10? So after I spend this 2 to 3 year money, what's there to replenish that? And that should be ideally sort of safe, right? You're willing to take a little bit more risk because you don't need that money immediately, but it should be paying a good interest rate into replenishing that bucket of dollars that you're spending out of. And then as those dollars mature, they then replace and replenish fully that bucket of dollars that you've spent. When you've got your near-term money all set aside and safe and secure, and your intermediate-term money paying interest income and have a set maturity so it's available when you need it, then the money that you don't need for 8, 10, 20, 15 years, right? Those dollars are free to go out and fight inflation and grow long term. And that is, you're comfortable investing those in a diversified mix of multiple strategies for the long term. You can withstand the temporary ups and downs for that long-term reward that stocks have always provided, given enough time horizon, and you've got that time horizon because of how you've structured your other investments. So you've got to be aware that those short-term dollars are currently having a higher interest rate than those intermediate-term dollars. That's okay. That's a distortion in the overall economy. It's not supposed to work that way, but that's how it's working right now. And then the second application is the more threatening one, and that is every time since 1950, and there's even more to that than that, but I'm going to oversimplify, that we've had an inverted yield curve. We've entered an economic recession within about 18 months of that happening. And there's all sorts of question right now that, the economy is slowing and corporate earnings have come down, and yet the labor market feels so strong and there's still a lot of demand. Therefore, we're not in a recession yet, right? So you can look at that. We've got the lowest unemployment rate that we've had in how many years, right? And yet there's a softening of the economy, and you've got this telltale distortion where, yeah, we're really raising interest rates in the short term, but over the long term, they're not that high. We've got this inverted yield curve. Yet to see whether that means whether this time will hold true, or whether there's been so much market manipulation over the past 3 years that this one will be a rare occurrence where we had an inverted yield curve, a significantly inverted yield curve, but we don't dip into a recession. We'll see. So, what's the application? What should you do with this? Work with your certified financial planner to make sure that you've got the right investment structure depending on your situation. And if you're at or near retirement, build out that personal pension plan and be aware of this yield curve phenomenon, this inverted yield curve, and make wise investment strategies based on that. And then second, it would be prudent, just because of how likely or how sure this indicator has been in the past about a looming recession. It would be prudent to take a look at your overall financial house and say, do I have my house in order in case the economy gets worse from here before things get better? Do I have the right levels of emergency fund, paying down debt? Have I been saving up? Am I prepared? Work with your certified financial planner on that. If you don't have a CFP on your team, contact one on my team. You can find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.